Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and welcome to our Outlook series for 2025. This panel will be diving into how to allocate $1 million for 2025. It's an asset allocation extravaganza, and to help me figure out how to tweak your portfolio, get some tips for keeping it in good health in 2025, I'm joined by Charlie Viola, who is Executive Chairman and Advisor at the freshly minted Viola Private Wealth. Charlie, great to have you on board.
G'day James, how are you mate?
And I'm also joined by Ben Clark, Portfolio Manager at TMS Private Wealth, also a fresh brand and a new look at TMS.
Absolutely, Jimmy. Bring in 2025 in style.
Okay, great. Well, listen, gents, super excited to have you here today. We're going to be doing a bit of an overview of some of the big factors impacting asset allocation and what you're thinking about for 2025. Keen to understand some pro tips on rebalancing. I reckon it's going to be appropriate after the year that we've had. And we'll get into your asset allocation weights and how you're putting that into practice. And for you viewers out there, something a little different. I'm a bit nervous. I'm going to reveal my SMSF portfolio, and Charlie and Ben are going to take the knife to it, tell me all my flaws. Charlie said he didn't know what to do with my SMSF, whether to make fun of it or not. And Benny, I had no response from you, so I'm a little nervous.
Look, I was actually having a coffee looking through it and struggling to find too many criticisms. So, I don't know if we'll be taking a knife to it from my point of view, but there's always things you can do better.
Mate, you're a good bloke. You're being very generous there. Before we dive into what we're looking at for 2025, just do a quick round the grounds on asset class performance. It's been a good year. S&P 500, 25%. Aussie equities, 10%. Fixed income, there was some return in there, mid-single digits there. Gold, up 27%. Cash, RBA rates 4.35. You could probably do a bit better than that in a term deposit. And Bitcoin, I didn't know any, 146% for the year. Bit of an outlier there. So let's get into it, Charlie. Looking forward to 2025. What are the top 2 or 3 factors influencing your asset allocation decisions for the year ahead?
Yeah, it's been a cracking 2024, hasn't it? And we've, obviously seen client portfolios do really well, and equity markets have done lots of the kind of heavy lifting over the last 12 months. And really, equity markets have done lots of the heavy lifting since about 2009. Markets have virtually done nothing but go up over that period. So, I think the first major influencing factor for us in terms of how we're allocating money over the next little bit is probably valuations. I think it's probably fair to say that markets are on a tear and they've been roaring their heads off. It probably just gives us reason to pause just a little bit, just in terms of how we're allocating new money, how quickly we're allocating to markets. Where we've probably landed on this stuff is we're still happy to allocate to equities, and we're certainly still happy to allocate to global equities. We're probably just going to do it slowly throughout the year and make sure that we're still just buying into good quality over time.
Yep.
I think the second major influencing factor, I think, probably is interest rates. I think markets have probably priced in reasonable size rate cuts for the next 12 months. We're probably not all that sure that they're going to come through. So, we're just mindful of, where these kind of multiples have gone and the impact of those rates, and whether or not, if we do actually get sort of disappointed by how quickly the Fed kind of cut, or whether the Reserve Bank cut at all, and we're still not sure that we will see any rate cuts domestically over the next 12 months, whether or not we actually see markets sell off a little bit. So, and then the other one for us is obviously just the impact of inflation. And I think you've got a graph that we sent you. So we're just not looking to allocate any monies at all to anything with any duration attached to it. We think it'll get smashed around a bit. So,
and that's because you expect that inflation to stay a little higher and not to drift back down to those long-term trends that you can see on the chart?
Yeah, correct. So, and especially in the US, given the Trump policies in the US and the very pro-business that he has been, and opening up the economy there and kind of re-accelerating what's been going on there, it's likely to have some sort of inflationary impact. So we're going into the new year with optimism. You were talking about your son before, about how optimistic he is about life. We probably don't have that much optimism, so we're gonna edge our way into markets over the next 12 months and kind of deploy money. But we still think we'll generate positive returns over the next 12 months.
Okay. Ben, same question for you.
Yeah.
Top 3 factors that you're thinking about as we go into 2025?
Yeah, I think I'd echo Charlie's comments on number 1. I think valuations, you've got to look at where we're at. So I've sent through a chart that we actually had in our client review packs from the second half of this year, which shows the earnings yield of the ASX at the moment. And you can sort of, if you're looking at this chart, you can strip out the GFC when analyst estimates were all way too high, strip out COVID when analyst estimates were all way too low. And, you know, this is like a 30-year chart and it shows you the earnings yields now sub 4%, which is a bit of a rarity over that.
It's a real anomaly on that chart, isn't it?
Completely. So, like, our DNA, as you know, is investing directly. So we look at all the asset classes and we're here to talk about asset classes. But for mine, our biggest exposure is the ASX, and I suspect it's most of the viewers' biggest exposure. And I would say across the market, it's looking more expensive than we've seen it. Now, I would preface that by saying, you know, for me, we're kind of 2 years into a kind of a bull market post that 2022 horrendous year. And it is typical that you do see a market that looks more expensive in the early years, and then you start to see consensus earnings upgrades coming through, and it doesn't turn out. But we're definitely a bit more wary on allocating to Aussie, definitely doing it slower. And I would also echo Charlie's views that the temptation is that you start to buy the cheaper stocks because they haven't run so hard. And I think that's a real trap that you can fall into. Even you still got to stick to the best quality businesses, even if they've been the best performing businesses. So that would be number one.
Can I just ask you a question very briefly on that?
Yeah.
This chart is at the index level, let's call it. How much do you think this skew is being driven by, you know, the dominance of something like a CBA, which is super expensive at the moment, a big part of the index?
100%. So, and I would also say, before you run out and sell all your shares and think the Aussie market's expensive, there are pockets of good value. You know, like I would say, healthcare stocks look quite cheap. If I was picking one theme into 2025, it feels unearly similar to 2024 when everyone was so negative on the banks. They were really cheap. And we saw them rip despite no real changes in their underlying fundamentals. And resources could do that this year. I kind of feel like it's completely unloved, it's cheap. The banks could be used to fund the resource trade, and you know, we see that go back the other way. The market at a top line level in the blue chips looks expensive because there isn't a lot of earnings growth amongst our big blue chip shares. And but there are still, you know, companies that are growing well, and we would still favour. So it's, you know, it's more maybe a stock picker's market than ever.
Okay. Next 2 points.
Next 2 points. So second thing I'd say is starting for us. It's been starting to look at some different asset classes, such as the alternative space, which have lagged over the last couple of years, and that's been largely driven by a more incremental adjustment to valuations as the bond yield curve has changed, whereas equity markets did that very rapidly. And also because IPO markets, etc., have basically been closed for the last while, it's been difficult for some of these private equity firms, etc., to exit investments. And I think that's changing. So that would be point number 2. And point number 3, I'll go the other weights, Charlie, on this one. We think locking in duration is the right thing to do. And so within the fixed interest class, we have been starting to reduce our floating exposure and going into fixed. I think finally 2025 will be the year that we start to see rate cuts in Australia. And we've been locking in some investment grade bond sort of stuff.
Okay. I feel like we need to have a wager on this. We're going to come back in a year.
Let's do it.
We'll dive into this because it is a notable difference in the asset allocations that you've both put forward, which we'll get up a little bit later on for viewers. So why don't we come back to that point on duration? Okay, bit of portfolio hygiene. After a great year, as we talked about, you know, people are probably looking at their portfolios and looking at a number of winners and investments that have performed really well. Talk me through rebalancing. How important is it? How should people, what are a couple of tips on rebalancing and how important is it to portfolios? Charlie, I'll start with you.
Yeah, there's lots of studies in behavioural finance that it's really hard to take value, right? Like it's very hard not to keep chasing the winners. And we see this all the time, but nobody ever went broke taking profit, you know, nobody ever went broke backing winners kind of thing. So, so we actually believe it is the right time to actually start to take a bit of value. The banks especially are just off their heads expensive at this point in time. I think our banks, I think I read somewhere that our banks are the most expensive in the world at this point in time. So we think slicing a little bit out of, you know, where people have got large overweight allocations to Australian equities, we think people should slice a bit out of that and reducing their exposure by sort of 10 to 15%. And then obviously global equities sort of driven by all of the sort of top end of the index. most Australians invest in global equities using the indexes, right? And the indexes have been the absolute right place to invest because all the good stuff kind of floats to the top anyway. And it's, so we think people should be taking a bit of value there. And we're certainly saying to clients, look, where we can and where it makes sense for you and your portfolio, let's actually take a bit of value and let's start to reinvest in a few of those kind of private market areas where we're then building returns for the next 5, 10 and sort of 15 years.
Yeah. Ben, same question for you, rebalancing?
Yeah, so I mean, rebalancing, I guess the other thing that you've got to continually remind yourself is investing is a long-term game. And, I think it sounds like we're kind of lining up on what we're thinking. It might not play out, so often what you think is going to happen doesn't happen. Markets constantly wrong foot you. So it's something that you want to incrementally do. You don't, if I was giving one piece of advice, you should never have an all-in or all-out approach. Go to cash because you think the market's expensive. Market keeps running, you're suddenly like, geez, what do I do now? And so for us, it's incrementally making changes through the year and not sort of, it's maybe going overweight, underweight various asset classes as opposed to taking a big holistic view on
all in, all out sort of stuff.
Yeah. Like the global is an area we haven't spoken much about, and that's an interesting one. I brought a chart from our review pack as well, maybe we could have a look at. Yep. Where we're more relaxed about valuations and exposure there, and we've kind of been happy actually to let that run because what we're seeing, like if my sort of 2 cents worth on what's going on in markets at the moment is 2022 was a big wake-up call for the blue chips in the US. They were ruthless in cost cutting, their revenues kept growing, but their profits have been growing much more rapidly because it's on leaner cost bases. And so I can't see that that's going to change over the next few years. And if you look at this chart, you can see that the ASX 200 has delivered 51% profit growth over the last decade, and the S&P 500 has delivered 167% profit growth. So, you can look at global and versus Aussie and think, global's run so much harder and that's where I should be taking money out of. But it's actually been much more logical that it has run harder. And if I was a betting man, if I fast forwarded 10 years, I wouldn't be surprised if you see a similar outcome in the next decade. Yeah. Because I can't see a lot of profit growth coming out of our blue chip. So indexes work well, but going forward, particularly for the ASX, I'll be a bit more careful on it because I just think some of those big companies aren't growing and valuations look really full. But global, we're happy to stick with. I think, and I still think there's a really good case to be there.
Great. Well, listen, let's get the asset allocations up and running. I asked both of you to share a typical style allocation for 2025, knowing that each client is different needs and all that sort of stuff, but you guys have played ball. Charlie, I'm going to start with you. We'll get the chart up on the screen so viewers can see it. Talk us through the allocation, how you're thinking, and maybe call out some of the bigger weights that you got there.
Yeah, so I think we've probably agreed with a fair bit of what Ben has said along the way, and we're sort of agreeing. Australian equities, we've got a lower allocation than what we may have had in the past, just because we purely think that there's not going to be a heap of growth there over the next 12 or 18 months, or even maybe really into the sort of foreseeable future. So our position there is lower than what it has been possibly in the past. Global equities, again, we're a little cautious. We're sort of cautious in terms of how we allocate the money, but we still think that those markets will continue to run. So that doesn't mean that it's not good kind of portfolio management to take some winnings at different times. But we still think that there is upside. We still think that the effect of Trump and the pro-business nature that's going on, and the amount of capital that continues to flow into that kind of really kind of top end of the market will continue. So that's going to drive our asset allocation there. Growth alternatives to continue the theme that we're talking about, private markets.
Private equity.
Yeah. So growth alternatives is private equity across all the various sleeves. Asset quality, diversity, and picking the managers and picking the jockeys who are looking after your money becomes really important, across this. So the due diligence that we do around manager selection and what they're doing in terms of asset selection becomes really important. But we believe that over the next 5 or 10 years, that's where lots of the return is going to come from. So we'll continue to kind of allocate monies there as opportunities present. what we call defensive alternatives. We think it's still a good way to generate returns. A lot of that is still going to be private debt, private credit.
And that's an income-like return, right? That's
exactly.
That's distributions. And
given where rates are, and given we think that rates will still remain reasonably high, we still thinking investors are generating sort of 8 to 10 to 12% annual returns out of that sector. To be really clear though, we know that once was an investment banker, now as a private credit manager, we know that there is this explosion of private debt and private credit. We are very careful in terms of where we're investing, who we're giving our money to, what sponsor strength looks like, what the asset backing is. We are very mindful to make sure that we're giving the money to people we really trust and they understand their processes, because ultimately we always want that money back, and we absolutely understand with credit there's somebody on the other side who's actually got to pay for this. So the risks have gone up, but there is still a good investment return, and we still think returns are probably asymmetric to the risk in that sector. We're well and truly underweight fixed income. We don't like it. We think duration is going to get smashed around. So we're probably not going to invest too much in that area. And then we'll hold a little bit of cash, which is really just sort of sitting there waiting to, for weakness and opportunity and other things.
Okay, very good. 10% cash, that's a pretty stable holding for you guys?
It sort of is, and it kind of floats up and down depending upon if we see weakness in market or we see an opportunity come along, we will go down as far as kind of 2 or 3%. We always feel like we've got lots of liquidity in other parts of the portfolio anyway, but there'll be periods of time where we will just kind of sit on our hands just a little bit and kind of wait for those opportunities to come along or that weakness to come along.
Yeah. Okay. Ben, we'll get what you've sent through. Yep. Do you want to give us a bit, is this a particular type of client that you would be allocating for? Is this kind of the base framework that you work off?
Yeah, that's a good point. So probably someone who's a bit younger and a little bit more aggressive, I would say, less income conscious and looking for more growth as opposed to stability. I think Charlie and I would both have a very similar approach where neither of us put one client, well, don't let me quote you, Charlie, but neither of us put one client in a specific box and say you've got to invest in this way. It's like building a portfolio around that individual's circumstances, what they're trying to achieve. So this is a bit of it's an exercise, but it's a reflection of what we've been doing, I guess, in terms of the percentage movements of some of these asset allocations over the year, where we've been reducing down Aussie equities for the reasons I've been discussing, and definitely of the view that if I look back over the last decade, it's probably the lowest level of exposure we've had to the ASX. Yeah. So it's pretty meaningful for us.
And you love the ASX, Ben.
I do. So, but look.
You almost say that with a tear in your eye.
Oh, well, I think the good thing about public markets is they give you you can earn outsized returns if you can get them a bit, I think we can all sense at the moment that things are a bit frothy. And trimming money at the moment, and then we all know there'll be a dark day at some point again. And there'll be times where, as Warren Buffett said, where it's raining gold and you just got to find a bucket and walk outside with it. And you want to be prepared for those periods. And also, I think, you do want to be trimming some money after what's been a really good couple of years of returns. And that really, has almost been parlayed into this alternative. And that's been the main changes that I think have happened in our portfolios over the last 12 months. We've probably sat with 25 to 30 private equity managers. I mean, the thing with private assets and this area is you can't buy an index. So you really, the manager is important, and their processes and how they invest and understanding liquidity and all these, they've all got fairly individual T's and C's around the structures, etc. So we've been doing a lot of work into that this year, I'd say, and 25 to 30's come down to 4 that we've gone into, 4 to 5. There's been one venture capital that we did as well a bit earlier. I'm actually quite excited about it. And speaking to clients, many of our clients, this is a new area too. They've also, I think, really embraced this part of the market because these structures are becoming more friendly to individual investors as opposed to institutions. Access is getting better through advisors, and that's been a bit of a game changer as well.
I think the other thing that's happening, if you've seen the development of private markets, the flow of capital into private markets, the types of companies that are staying private, I think it's more apparent to investors what the opportunity actually is.
Yeah.
Whereas before it was perhaps a little opaque or not as well understood by the broader public.
It's just way more accessible too.
I mean, you look at how the big guys invest. The Australian Future Fund, which is the biggest pool of capital in this country, has 34% in private equity and alternatives and infrastructure. I think it's got about 8% in Australian shares. So that gives you an idea of how the really big guys and their investment committees look at providing a long-term return. And so I think that's worth taking notice of. The other thing of us, like, I think there's an area of disagreement, which is always healthy.
Well, let's dive into it. Let's talk about you like duration. It's been on the nose for as long as I can remember now. The poor 100%. Fixed income manager having a rough time. Charlie, you're staying well clear of it. Ben, you like it. So maybe let's hear a couple of the points that support your views.
Yeah, so I think at the start of the year, we've got quite a lot of floating rate corporate exposure, and it's been an area of the market we've been pretty active in. So particularly in hybrids, which of course are soon to disappear, the banking hybrids. They've provided great returns. So it's a bit of a head scratcher as to why that market is being wound up. But regardless of that, particularly in the first quarter to first half of this year, we were locking in high 6% returns with a CBA, a Lloyd's of London, printed a 7.1% bond, fixed for 10 years. So there's risk of capital loss. There's also potential for capital gain dependent on what rates do when you're taking on that duration. But I'm pretty confident on it. I think Australia is just another 6 to 12 to 18 months behind every other country which is now in a rate cutting cycle in the Western world. I think there are signs that our economy is slowing quite rapidly, and we could see 2 to 3 rate cuts next in 2025. And if that does happen, and I know that's a big if because it's been the widowmaker trade, everyone predicting rate cuts, and it just hasn't happened. And there are a lot of very smart people that are in Charlie's camp and think inflation is going to stick, and this maybe is a neutral rate. We'll see, but again, it's not an all or nothing bet from us. It's some of our floating exposure is now fixed, but we still have a decent in floating, and it's more sort of thinking that we think the balance of risks are now more even. And if
you're willing to have an allocation to that camp.
Yeah, because you'll get some capital growth as well if that does play out.
Charlie, you're not keen on duration. Maybe underwrite your thesis for us.
Yeah, we're just happy to remain floating rate. It means that we're going to continue to get the return now on those floating rate notes, and we do have some exposure to that, especially in our institutional client portfolios where we're required to hold these sort of fixed interest style investments. It allows us to kind of generate this return over the next 6 or 12 months while we wait for those rate cuts if they do come, and we will have received that return through that period without taking on the additional risk of actually having to make a bet that we are going to actually see rate cuts over the next 12 months. Because while I say it with all great unequivocalness, I really don't know, right? We really don't know whether or not we're going to see rate cuts or increases. The reality is that the noise coming out of the Reserve Bank is never particularly consistent. The inflation numbers are actually really hard to read into whenever you have, and because remember that residential property continues to sit outside the bucket. And I think that always kind of influences the actual inflation numbers. So I do think though that the economic data is actually reasonably weak, and not to kind of contradict myself, and we're not seeing huge amounts of kind of wage growth, which kind of leads Ben's point to be slightly more correct. I just don't see the Reserve Bank having any confidence in terms of going out and kind of cutting rates because of the impact that it might have to inflation when they still don't have their foot on the throat of inflation at this point in time. Yep. So I just don't know that we need to take the risk. We're happy with the return that we're getting out of the FRMs.
The front end, there's enough yield there at the front end, and you can
correct.
kind of bounce around with movements.
I think the other thing, the US is more complicated as well, I'd say. Like I think there could be a case where rates do store at a higher level than markets are anticipating, and that will actually reverberate to the Australian bond market even if we do go into a rate cutting cycle. Certainly not to overcomplicate it, but I can see that playing out. I think with a Trump presidency, I think there are signs that the US economy is actually motoring along very nicely, and the market's still pretty aggressive in where it thinks rates are going down to. So it's not easy. I think you got to, like, the macro stuff's important to understand and to look at, but still got to zero into your individual investments.
Alrighty, so we've seen the hypotheticals. Let's get a little more gritty. I'm feeling a little nervous. Put myself under the blowtorch here. Ladies and gentlemen, just a quick note, sharing this hopefully to give some insights into how the process works. Definitely not a recommendation to invest in what I own. I'm not a financial advisor. You're better off speaking to one of these two gentlemen. But there you go, the SMSF is up there. A few notes about me. I'm 44. I work around markets and I have done for a while, so I'm reasonably tolerant to risk. Funds I've invested with, generally I've known for over a decade, if not more. They invest in their own funds. They're often owners of their own funds. Direct equities, I don't do a lot of it because of my job, so I don't tinker. And there's also commercial real estate, which the super fund owns, and that is where my wife works and generates her income. So a few little insights about the portfolio. Gents, Charlie, as I said, you wanted to put the boot in first. Maybe a few comments around what you like, what you don't like, what you change.
Well, you've certainly been rewarded for your risk over the last 12 months or so. You've obviously got a reasonable allocation to these kind of emerging companies and small cap funds. I would say that medium to long term, we'd like to see that balanced out just a little bit. I think you're underweight global equities as far as the way that we would probably do it over time. You've got no alternate exposure in there, which you are very young. You've got a 50-year time horizon. You're going to earn bucket loads out of this business over the next number of years. So you're going to have plenty of disposable income to keep kind of tipping in there. In terms of a couple of those kind of Australian equity funds up the top, we think you should probably trim those a little bit, move those down into large cap global and start to get some exposure there, and then make some room for some really good quality kind of long-term private equity in the portfolio. Done really well, needs a little bit more balance. I think you've really only got 2 buckets of money there.
I'm sitting on one side of the boat.
Yeah. So a little bit more balance and a little bit more private equity. At your age, you don't need the income generation. You don't need to go and buy private debt, which is generating 8 or 9% yield. Given your age, you're happy to kind of back this horse, which is really backing the horse around, global growth over a long period of time. And you're obviously a believer that small companies will outperform large companies over time. That's okay, but it is better to be done in the private equity space. And again, it's a little anemic on the global side versus domestic. So a bit like Ben's portfolios that he was talking about, and ours. Shave your Aussie, add to global, add
Make
private
some room
equity,
for a bit of private equity.
You've done well.
All right, Benny, same question for you.
Yeah, I guess I'd agree with a lot of those thoughts. I mean, just a couple of things I could add in. Like, I think if you looked at how these fund managers correlate, I reckon there's a very high correlation.
That's probably my biggest concern.
Yeah,
is that there's 2 managers doing the same job, very similar styles, particularly on the global front.
Yeah, but the thing I would say is they're very high quality managers. So we've got money with Hyperion, and I think it's about as good as you'll find in the Australian market to manage global. Munro, a great manager. I know the guys well at Eli Griffiths, and they are as good as I think you'll find in the small cap space. But it's probably the exposure to an individual fund. Some of them, maybe are a bit high versus the size of the overall portfolio.
Yep.
And also, I think bringing in that private equity and alternatives exposure is just going to mean that there will be a down year. And I think this portfolio, if you went through 2022 with a similar portfolio, it would have been a hair. Yeah, because I think there were 50% drawdowns in some of these managers during that period.
Definitely there were.
And it was simultaneous. So, which is a time that you think, okay, everything's on sale, it's raining gold, but where do I take money from to get some money into this? And if everything moves in the same direction, it's a hard decision.
Yep.
You've got good income coming out of the property. So I think also being disciplined about consistently pumping that back in, and capital allocation's an important thing. Where's their value? And if you've got $5 grand coming out every month in income, and you can look to reinvest that, making sure it's not sitting there in cash and getting too lazy, and every month you're looking at it and doing something
Putting it back
about
to work.
it. Yeah, completely. But I can't add too much more. But I've got to be honest, Jimmy, I think if you hold this exposure, which I think both of us wouldn't suggest, but if you did, I think you're probably going to do pretty well over the next decade, but you're going to go through a lot of ups and big swings, ups and downs.
Yep.
And you definitely need to be prepared to take that on.
Yeah, I mean, I just wouldn't have, kind of whatever it works out to be, 28% sitting with the same manager in the same spot, because there's going to be a fair bit of crossover between those two funds, to be fair, in terms of what's actually being invested. The only way that you ever generate really good outperformance is concentration. You're just taking way too much concentration risk in that portfolio. And I make the point again about global equities. Global equities will do well over the next 10 or 15 years, and you only need to really invest in the index because, like I said, indexes tell a story. All the good stuff sort of floats to the top in any case. So if you're going to dollar cost average because you're generating a heap of income out of the commercial property, just keep sticking it into, the S&P 500 or VTS or, IOO or one of those, where it just allows you to kind of continue to buy in across the various different kind of market cycles. And then, like I said, you're old enough to understand the risk and young enough to take the long-term view.
I feel like I'm being given an opportunity to rebalance and take some of that off.
The good thing about this conversation is the time we're having it, because I'd say most of these funds are trading at all-time highs. So as we've been doing with our portfolios, it is an easier decision to make to skim off some holdings and recycle. It's a harder decision when markets are corrected 10 or 15%. These funds might fall 20 or 25% in those sort of conditions because of the high beta that they've got. And then you look at it and you think, I'll wait. And, ultimately
there's an opportunity cost there.
I think so, yeah.
And there are some really good quality, well-run, reasonably liquid private equity funds that you can now invest in a fund of your size. The Schroeder Private Equity Fund, the Federation, alternative investments. Like there's a bunch of those types of funds which are just really easy. You can allocate, they're liquid, you can allocate money every month. You should tip a bit of stuff into that and let it run over the next 10 years and you'll be fine.
Alrighty. Well, thanks, gents. Ladies and gentlemen, I hope you found that useful. If I do some work on private equity, I might put together a wire and tell you what I find and keep you updated on the SMSF. But Ben and Charlie, thanks so much for coming in today. Really appreciate you taking the time to prepare, share some of your insights and your allocations, and thanks for going easy on me with the portfolio.
Awesome. Thanks for having me, mate.
Thanks, James.
Ladies and gentlemen, I hope you enjoyed those insights from Charlie Viola and Ben Clark. Remember to check out our YouTube channel for all our Outlook series content. It's running live through January and it's an absolute cracker.